Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning. This is Quincy Krosby. It is Monday morning, July 3rd, and this is The Talking Point. Thank you for joining me this morning. This is a shortened week for the market, including today, July 3rd. The market closes at 1 o'clock, and obviously we're closed tomorrow, but yet it is an important week for a host of important economic data releases. But first, before we get to that, let's look at some of the events from last week, particularly from the European Central Bank's conference with global central bankers, including the Federal Reserve Chairman, Jerome Powell. He sent an important message to the markets. It was hawkish. It was, we need to continue raising rates. We need to have a more restrictive environment in the markets, and basically suggesting that the Fed is not finished by any means. Now, that doesn't mean, by the way, that the Fed is actually going to come in and hike rates again and again and again. No, it depends on the data, particularly on inflation. But the market does see that we're going to have a rate hike on July 26th. Personal Consumption Expenditures Price Index report, the PCE, which is the Fed's preferred picture of inflation, came out on Friday, and the headline number did come down. And it came down actually quite meaningfully. However, the core PCE deflator was not down enough for the Federal Reserve. And, it's clear that the Fed is focused on that, and they are probably going to come in and raise rates unless we hear something different from the Fed. Now, already what we are seeing is a tug of war between the doves and the hawks at the Fed. Raphael Bostic, the president of the Atlanta Fed, has come out a couple of times now suggesting that the Fed should just stop, just be done with it, and pointing to the lagged effects of the 500 basis points of rate hikes that are still unfolding into the broader economy. He said, let that play out. We don't need to hike anymore, versus the hawkish side. And that is most emblematic with Loretta Mester, who is also not voting until 2024, president of the Cleveland Fed. And her view was actually, hey, why are we waiting? And she didn't even think we should have skipped a meeting at all in the last meeting. And she said, no need to skip any meetings. Let's raise rates. So it's clear this is kind of an open public debate within the Fed. Chairman Powell is very cagey on this, I do want to say, because with each comment that he makes, he tends to qualify it where you don't really have an idea of where he belongs. Most likely, though, he will go with a rate hike if other indicators do not suggest that the Fed is finished. With that said, the week that we are in now, I can't express enough how important it is for the Fed, and particularly for the payroll report on Friday. We are going to be looking at a couple of important indicators. One, obviously, is wage growth. Are wages moving higher, or have wages leveled off? Clearly, the Fed wants to see that wages are not moving higher, and obviously the reason is when wages move higher, I've said this over and over again, companies want to pass along that higher input cost, which happens to be wages, to us, the consumer. Whether we're retail, whether we're other companies, they want to pass that along. But having the wages level off would be a net positive, that maybe this wage hike spiral is actually easing and is broken, because again, you don't want to see what's called an entrenched wage price spiral. That's one thing. The other thing we will be paying very close attention to is the number of hours worked. Obviously, when hours worked climbs higher, it's a clear indication that demand is higher. Demand for labor is higher. But in the last report, we saw hours worked come down. And it came down to a level which you have to have a question mark in terms of demand. Is demand slowing? Is it slowing more than other data releases are suggesting? That's why it's important. And we need to follow that, because one of the things that you start to see happen before a recession is that demand comes down, and it is reflected in the number of hours worked. So that's going to be important. Now, overall, expectations for gross domestic product is still solid, not stellar, but solid, not dire, absolutely not dire. In fact, what we saw for the first quarter final GDP report is 2%. So we'll be paying close attention to how the numbers, resolve themselves for the quarter in the second quarter. Right now, they're trending just below 2%. The other thing I want to point out here is that when we take a look at the data coming out now, remember, even though we've crossed over into a new quarter, it's still numbers that are backward looking, correct? So we need to realize that that's all going to be digested in the GDP estimates. This week also, what we're going to see is, beginning today, and it'll come out well after this call, we will get the ISM, Institute for Supply Management, manufacturing report. Interestingly, in some of the reports, it's getting to be less bad. That doesn't sound very scientific, but it's important. Less bad is that it's still bad, still in contraction, but actually not as bad as the report before. This is going to be important, what we see for the last month. We're also going to have construction spending. Also, this week, the ADP private payroll report is important. It doesn't match exactly with the government report that comes out on Friday, but the trajectory tends to be the same. Not 100%, but, if you see a large number, more than expectations, on Wednesday for the private sector employment report, the ADP, the market tends to expect to see the same trajectory for the Friday's government report. And we'll also have factory orders. But I do want to mention that one of the reports that's coming out is the Fed minutes. And normally, at this stage, you've already figured out what the Fed is thinking. But because there was a pause, I think the market wants to see, okay, what were you thinking about this pause? What really was behind it? And trying to figure out what does it mean for the potential of future pauses. So that's going to come out on Wednesday. And then Thursday, we're going to have the service sector, the Institute for Supply Management, ISM, service sector report. Now, in both the service sector, and by the way, the service sector is up slightly in headline in terms of being in expansion territory. That is to say, it is above 50. The ISM is below 50, but the question will be whether or not it climbs up just a little bit more than it was in the last report. So at the service sector and the manufacturing sector, we are going to focus on prices paid because they have been coming down. And that is one of the really important points for the inflation picture. You want to see prices paid coming down, and we don't want to see it turning back up. So that's what the market is also going to be focused on. And then on Friday, we are going to have the payroll report. And for the Fed, this is really important. Remember, Chairman Powell has lauded, even when he was speaking in Europe last week, of how strong the labor market is. And his goal has been very clear, that basically he doesn't want to, destroy the labor market in order to bring inflation down. Because remember what the important link is. The stronger the labor market, the more we're going to see consumer spending remain resilient. And consumer spending is approximately 68% of our economy. So that's how it runs. Now, the expectations are that the unemployment rate may come down from 3.7% to 3.6%. So we want to keep our eye on that. If, as I say if, the unemployment rate climbs again from 3.7% to 3.8 or 3.9%, it would obviously send a signal that companies are laying people off. I mean, obviously. But, in the initial unemployment claims, they've sort of leveled off. The continuing claims leveled off. So we're in this period of transition with the labor market. And very often when there's a transition within the labor market, the data that are released. I say ARC is data. Actually, it is plural, but I switch back and forth, as you can hear on this call. Data is data ARC. But when the data is released, very often during a period of transition and with payroll numbers and labor market patterns, it can be difficult to ascertain exactly where the labor market is. So this is important. We have to understand it. We also have to understand there are going to be adjustments, seasonality factors in. That said, above all else, let's pay attention to the wages and pay attention to the hours worked. That will be very, very important. And so as we get through this week, the market is going to be increasingly focused, however, on the beginning of the earnings season, which begins July, second week of July, and we will begin with the banks. And that is going to be very important. We'll talk about that on Monday's call. But overall, this is a market that had a tremendous rally in the half year and last quarter. Statistically, when you have such a strong half year, it tends to roll over into the second year, and it's very rare that we don't see that. So the market is focused on that particular stock of data, but overall, this is a market that is also focused on what is the Fed going to do. At some point, we will stop talking about the Fed because they are going to be finished. The question is when and how are they going to finish up, and what is it that they need? And clearly what they need is to see core inflation coming down to the level that they believe is supportive of price stability. So the question is, do they do it with another pause perhaps this summer, or do they, continue? And as he pointed out last week, he said, look, this could be continuous. One thing we do know, and that is the Federal Reserve tends not to get involved in the period in which the campaigning and the political season. So they may want to be finished up much earlier and get finished with what they have to do. Chairman Powell has said over and over again, if I have to put the economy in a recession to get this done, I'm going to have to do that. And most of the leadership around the world are on the same page. For them, the most important thing is making inflation livable and where consumers don't have to pay exceedingly higher prices. So it's going to be an interesting week to see how the market digests all of this information. Have a very good week. Have a wonderful 4th of July, and we will be back next week. Thank you again.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.